Want to find growing companies at a good price? Peter Lynch loved using the PEG ratio for this.
So you're trying to say some companies might have been overpriced at 60 and all they did was go to 50 and you'd say, big deal. So you're trying to find companies you liked anyway. Right now you liked them, and now they've had a haircut. That's what you would do. Not a stock that went from overpriced to fairly priced. Something was fairly priced at the start of this exercise and then had a very, a 5-for-4 sale.
The PEG ratio helps by combining the PE ratio with the expected growth rate. This gives a clearer picture of whether a stock is fairly priced. It adjusts the PE ratio to consider future earnings growth, making it easier to see if a stock is over or undervalued. A PEG ratio below 1 is usually a good sign. It means the stock might be undervalued compared to its growth potential. To find companies with a low PEG ratio, go to finviz.com and click on Screener. Choose the Fundamental tab. Find the PEG field and set the range from 0 to 1. Click Show Summary or Filter. This helps you find a selection of stocks that might be undervalued and have strong growth potential, which could be a great chance for future gains. Using the PEG ratio is key for finding the best growth stocks. It helps you see which stocks are fairly priced and have strong growth prospects, making it easier to invest wisely. Thanks for watching till the end. Now that you know how to use PEG ratios, try calculating them for some stocks. If you like this video, please like, subscribe, and hit the bell icon for more tips.